Guess I tried.
Hi there, it's Crystal Powell, real estate broker with RE/MAX Jazz, and today I'm joined with Sherry Corbett, mortgage broker with Mortgages in Durham. And today we're going to talk about what to do when the bank says no. So what do we do when they say no?
Well, so sometimes people do get an approval from the bank, but it's not as much as they want. So
Sure.
there's ways to work around that, or even if you do have a no, there's obviously lots of other lenders that we can work with. The key though is you have to have more than 20% down. So that's the key to this whole conversation. I'm going to level set that now, because if you have less than 20% down, then you're actually insured, and every lender, banks, credit unions, everybody has to play by the same government guidelines.
Sure.
With less than 20% down. So for the purpose of this conversation, let's assume you have 20% down or more, and the banks have given you approval of $500,000. You're like, oh, that's not going to get me where I want to go. Here's some awesome tips. There are lenders, people don't realize this, there are lenders out there who will not do what's called the stress test. What the stress test is say your interest rate you're given is 5%. The stress test means that you have to be pre-approved in the qualification numbers as if you're paying 7%.
Right.
So it's kind of like a buffer. So you're not paying 7%, but you have to qualify as if you could pay 7%. That's called the stress test. Banks have to follow that guideline.
Mm-hmm.
Credit unions do not. They don't follow the same act, the Banking Act. So you don't have to qualify at the stress test. You get to qualify at what's called the contract rate, your real rate.
Okay.
So that's a big difference there.
Huge difference.
If we're putting in those numbers and we're looking at income versus debt, and we're basing it off of 7% qualification versus 5%, which is your actual payment, that could probably give you a little bit more purchasing power.
Right.
The other thing is that banks are also limited under the Banking Act to a 30-year amortization, which means that they take your payments and they stretch it out as if you were going to pay for 30 years. Obviously, It's only a 5-year term or 4-year term, but a 30-year amortization. And they're locked into that. That's the highest they can go. 25 or 30 is the common ones. But there are lenders that go to 35 years, and there's even a few that go to 40 years. So again, you're just
So are those the same lenders that don't use the stress test?
Yeah.
Okay, so that would be so you're double dipping on the positives. Okay.
You got it. You're whammying. Not only are you not using the stress test, you're also extending it that amortization.
Wow.
So that could really increase your purchasing power. I've recently had a file where the purchasing power went up by $160,000 using those two aspects.
Yeah.
One caveat to know about that product though is that you have to have a clear understanding of where your exit strategy is, because in 5 years from now, are you going to be able to go back into a 30-year amortization and whatever stress test might be at the time? So most people are like, there's going to be equity growth in the home, or I'm getting a job raise, or my kids won't be in daycare, so the income, qualification for debt will be better. So it is something that you have to have a professional review the whole picture. It's not just today. We got to make sure that you're set for your future.
Yeah.
So those are.
And so here's another reason why you should work with a mortgage broker versus a bank, because they can look at many more options rather than just walking into a brick and mortar bank, and those are the only options there. Thanks so much, Sherry.
Awesome.
Bye.
Thanks.